Congratulations, you're pre-approved. Now what? How do I go about the process of buying a home? Where do I even start? I have so many questions, John. Help me figure out where to go from here. If that's how you're feeling right now, you are in the right place. And I'm going to walk you through everything you need to know about the process of buying a home. All right, start. So the first thing I want to talk about is, do I need a real estate agent? That is one of the biggest questions, especially here we sit in the spring of 2024, and I'm recording this, and there is a lot of noise around realtors, and I'll cover that in just a couple of minutes. But a lot of people say, John, I can buy a house without a realtor, can't I? Like, do I really need to have a real estate agent? What I'll tell you is, would you perform surgery on yourself? Maybe a better example is, would you represent yourself in a legal battle when the other side has a representative, an attorney who knows everything about the law, and you're representing yourself and you don't know anything? I have a lot of people who say, you know what, I don't think it's worth it for a realtor what they earn. And I think that I could do that myself and save that kind of money. Maybe, but it's what you don't know that will cost you. And there's a lot of situations I can tell you about where buyers ended up not using a realtor, and they ended up not understanding something was an option, not understanding that they could have asked for something, and it costs them thousands of dollars more than what it costs them to pay for their real estate agent. So do you need a realtor? No. Technically, you can buy a house without using a real estate agent. Should you have a realtor? In my opinion, 100% yes, because it's what you don't know that gets you in trouble. As a matter of fact, having a great real estate agent, just like having a great lender, you shouldn't feel the benefit of having that great professional on your side. It should almost feel like in the end, wow, that was really, really easy and smooth, and sometimes leaves you wondering, was it worth the money I paid for that real estate agent? But that's the point. The point is so many things that are handled underneath the surface, under the water. It's kind of like a duck floating through the water, and they look calm and peaceful on the top, but underneath they're paddling like heck. It's the things that happen underneath the surface that you don't know about, the contract negotiations, about the interactions with the lender, and the things that I needed to do with a realtor that the realtor is going to bring up to me that you wouldn't know to bring up to me. And so do I think it's important to have a real estate agent? Yes, I absolutely do. Is it mandatory? No. So let's talk about what's really going on right now. You're hearing a lot of stuff on the news. Depending upon when you're watching this, this may have already rolled out, and this may be just, you know what the facts are, but I'm going to take a couple minutes and just explain, because for a lot of my buyers, you're buying right now or about ready to buy, you're in the process of getting pre-approved, or for some of you, you're waiting for your voucher for Dream for All. And you're thinking about what's going to happen once I'm ready to start shopping. Well, what you're hearing in the news right now is you're hearing about what's called a decoupling of the buyer's agent's commission from the listing or seller's agent's commission. What has happened historically is when a seller lists their home for sale, the agent representing the seller, that's interviewing to represent the seller, says, hey, you're going to pay us X percentage, and I'm going to share that with the person that brings the buyer. So there's going to be somebody representing you, the seller, and somebody representing the buyer. And most buyers don't have the cash to pay for their own representation. The industry changed, and they said, hey, you know what? We're actually going to include that with the seller's costs so that the seller is covering that cost, because they typically have the equity where they can cover it, and the buyer doesn't need to come out of pocket with it. Well, now that is basically separating, and the buyer, you, are going to have to sign an agreement with your realtor. So do I need to sign an agreement with my realtor? The answer is yes. You control the scope of that agreement. But before you can go look at a home, you have to sign an agreement with that realtor that covers what you will pay them if you're successful in buying a home. Now, you can have the agreement be for one specific home. It could be for a short period of time. It could be for 6 months on any home that you buy. That's entirely up to you and how comfortable you are working with that agent. Just recognize that realtor is putting in a lot of time and energy and effort into you. And for you to say, hey, I want to look at homes with you for 7 days straight, and I want to look 3 hours a day for all 7 of those days. They just spent 21 hours with you. And now you say, okay, now I'm going to go ahead and look for another agent just for the fun of it. That person's put in a lot of time. So respect the realtor, but also don't be disrespected by the realtor. Some realtors, the moment they meet you, are going to say, hey, here's an agreement you got to sign here. I'm going to send it to your phone, and you have to agree to work with me for the next 6 months. Anything you buy, you have to use me for the next 6 months. You don't have to sign an agreement with that length of time. You can say, hey, let's date before we get married. You're in control, but the rules are effective August 15th. At least that's the current projected date. Starting August 15th, you have to sign an agreement with your realtor before you can tour a home. So be ready to sign that agreement. Be ready to talk to your realtor. Okay. So one of the questions people ask me is, how do I pick a realtor? Well, that really comes from, first and foremost, you got to find somebody that you trust. Now, sometimes that comes from meeting somebody and working with them and finding out that, you know what, I like this person and I jive with them, and so I trust them. Sometimes it comes from a family member or a friend who's used a realtor before, and you're saying, you know what, tell me, who did you use? And I'd like to interview them. Interviewing is the key. Interview one realtor. If you love them, hire them. If you don't love them, interview more realtors. Find out who you want to work with, who you believe can guide you through what is likely the single biggest financial transaction you will ever undertake in your life. You can also find a realtor by going through online portals and getting a realtor that is recommended by the portal. Just realize the portal's recommending that realtor not because they have a working relationship that they trust that realtor. It's because the realtor wrote them a check. So you're really getting a referral by fee. In other words, that realtor paid to be part of that system. Nothing wrong with that, but it doesn't make them a quality realtor. It doesn't make them a low quality or high quality realtor. It just means they were willing to pay the money to get the referral of buyers that are looking to buy in their community. The question is that enough for you? Is that enough of a recommendation for you to pick that person to represent you through this transaction? That's a tough decision. The final way is ask me. I know realtors all up and down the state. I know realtors in multiple states across the United States. So if you need a recommendation to a realtor, let me know and I can help connect you with one. All right. What is next? I got to put on my old person glasses here. All right. So let's talk about who pays. So this is kind of about the realtor commission thing. Who pays then for the real estate agent? Well, here's ultimately what's happening. You can ask the seller to pay your realtor's fees. You can say, hey, Mr. Seller, I've agreed to pay my realtor X percentage of the price of the home, and you're negotiating that with the realtor before you go look at the home. And you say, I've agreed to pay my realtor X percentage. I'd like for you to pay that as part of my offer. We'll talk in a few minutes about how to make your offer more competitive, but you absolutely have the right to ask the seller to pay your realtor's commission. So just because you're negotiating that commission up front doesn't mean you have to write the check. But officially, if the seller's unwilling to pay for it, you do have to pay your realtor's commission. So just be aware of that, but talk to your realtor about it. Have an open and honest conversation about, hey, what are the chances the seller's not going to pay for this? What happens if the seller isn't willing to pay for it, but they're willing to do everything else I want, and the only issue is we are not coming together on what your commission is? The truth is that's no different than when you want to offer $5,000 lower in price and the seller's $5,000 higher and you guys can't come together. You got to find a way to come together and negotiate. And that's where a great realtor is going to work on your behalf. Or you decide this isn't the right home for me. I can't make it work. So it's really important to understand that everything is negotiable in the real estate transaction, including the cost you pay to your real estate agent and who pays for that. All right. So let's talk about, man, my eyes are getting horrible. All right. How do I search for homes? So this one is a good one. I want to talk about and kind of share with you a little bit about ways you go about searching for a home. First of all, open houses are a great way to see homes. Now, you don't have to have a signed agreement to go visit an open house because you're just walking in and the realtor that's there is representing the seller of the home. Now, they can also represent you. Now, sometimes the realtor that's at an open house actually is the agent that's representing the seller. Sometimes they're just there on behalf of that agent. If you end up working with the agent that is representing the seller, that's called dual agency, which means you have you have two parties, you and the other side that you're negotiating with, being represented by the same person. That can work out really well, and it can work out really badly. It's really about the integrity of that person in the middle. because the realtor has a fiduciary responsibility. Fiduciary means that it is their requirement, their responsibility to act in their client's best interest. How can you act in the best interest of two parties that are on opposite sides of the negotiation? It's really hard, really, really hard. Some people do it really, really well. Many don't. And so just be aware of the fact that if you go with the realtor that represents the seller and you've got to be aware of the fact that your negotiation is hampered. Because, for example, you can't tell the realtor, hey, by the way, I'm willing to pay $20,000 more for this house. Well, the realtor has the fiduciary responsibility to the seller. If they're acting on that responsibility, they have to tell the seller, hey, by the way, I know you're willing to go lower, but the buyer told me they're willing to go up $20,000. So let's find something in the middle that's a win-win, which is great that they're creating a win-win. But it's bad because maybe you would have gotten it for the lower price and you didn't have to go up at all. So just be aware of the fact that going to an open house, sometimes you're going to find a realtor there that you want to work with. Now, they might not help you buy that house, but if they're the representative selling that house and you use them to buy that house, you've got basically one party representing both sides, and that creates some conflicts of interest that you need to be aware of. Now, how else can you look for them? Realtor tours are a great way to search for a home. What I mean by a realtor tour is your realtor takes you out to look for homes, takes you on tour. Now, what's the benefit of that? Well, first of all, the realtor should have previewed the homes or at least looked through and figured out which homes are going to match your needs. It saves you from just randomly going out and looking at homes. It's one of the values that you don't get when you use the third option, which is online portals. We can all look online and we can get a rough idea of what things look like. But a realtor who's local to that home has likely previewed it or driven it out and looked at the home because they have multiple clients looking in that area. And look, as a professional, that's their job, is to know the inventory they're selling. It's like a car salesperson that has no idea about the new car on the lot. I don't know anything about it. It's been here for a week. Sure, I'll sell it to you, but all I know is that it runs when you push the button and it's got 4 tires and a steering wheel. Well, that's not a real good salesperson. They should know their inventory. And so a great realtor who's local. I am a firm believer in getting a realtor that's local to the home that you're looking to buy, because they need to understand the nuances of the market. They need to understand the differences between one community and another, between one school district and another. And yes, realtors can sell anywhere that they're licensed, but you're really hiring somebody to be your representative, to be your guide, to help you understand the things that you didn't know. And if you got a realtor that's from outside of the area, they're going to have a hard time really knowing the nuances of that neighborhood. So then the third option is you can go through online portals. Again, you're playing realtor roulette at that point, because you're simply saying, hey, I want to go look at this home and I want you to take me out to look at the home. You have to sign an agreement with them before they show you the home. Even if it's limited to that one property, you still have to sign an agreement that says, I'm willing to use you to represent me through this entire transaction if I buy this home. So that's kind of realtor roulette. I'm not a huge fan of that. I think it's okay to use the portals to see what inventory is out there, but pick your own realtor and use that realtor to go out and find a home. And if you find something through the portals, send that to your realtor and say, hey, Mr. Realtor, hey, Mrs. Realtor, can we go look at this house at 123 Main Street? All right, hopefully that helps you with the process of how to search for a home. All right, so our next one, how do I decide what is the right neighborhood to buy in? You really have to think about home ownership as a lifestyle decision as much as a financial decision. Up until this moment, your lender, hopefully me, has been talking to you about financial components of what you qualify for, what monthly payment you can make, how much cash you're going to need to buy. But home ownership is emotional. It's about the stability and the security of having a place to call your own. It's about not having to worry about the landlord kicking you out. It's about being surrounded by a community that you want to get involved in, that you can build roots in, that you can raise your children or live your life in and be comfortable in that surrounding, because you're going to have neighbors near you in most situations, and you need to be in a situation where you know what you're getting. Now, sometimes you can't get everything that you want. That's about compromising. And that really is my next thing. What concessions or compromises am I willing to make? So as you think about buying a home and you say, oh my gosh, here's my perfect home. But that perfect home comes at a price, literally a monthly payment and an amount of cash you need out of pocket. And the question becomes, am I willing to pay that monthly payment with that much cash out of pocket for this home? If the answer is no, then you have to decide, am I going to stay a renter, or do I make some kind of a compromise, or do I make some kind of a concession to what I'm willing to accept in my perfect home? And that really brings to the point that very few people get their perfect home as their first home. Most of the time, you're making a concession. It's a starter home. It's called a starter home for a reason, because you start there. Down the road, you upgrade, you move to a different home. So don't think about it as it's got to be my perfect home. It doesn't have to check all the boxes. Now, if you can find your perfect home that checks all of your boxes, and you're willing to make the monthly payment, and you're willing to bring up in the amount of cash necessary to make those numbers work for you, by all means, do it. Do not compromise, but understand that sometimes that's your only option. If you're otherwise, your only option is to stay as a renter. So do I want to stay as a renter, or do I want to compromise? And guess what? You're compromising in some ways by staying as a renter. There is nothing wrong with being a renter. I'm in the industry to sell you on buying a home, but I'm not here to convince you to buy a home. My job is to help educate you and guide you. And so you have to decide, what concessions will I make? Am I willing to drive further away from my current region, my current neighborhood? Distance can make a really big difference. They say the number one thing in real estate is location. You know what the number two thing is? Location. The number three thing? Location. It's location, location, location. You can have the same property that is in the Central Valley that costs significantly less for the same size house, same lot, everything, as that same house that's on the coast. Why? Location. People want to live on the coast. It's by the water. It's beautiful. It's a lifestyle. The other things you think about with concessions might be, hey, I want to buy a smaller sized home, fewer bedrooms and bathrooms. I'll remodel and upgrade. Maybe I want an older home that is more outdated that I can update and bring to be what I want it to be. So just understand, you can make some changes to the home. What you can't change is the location. So for a lot of people, they say, you know what, I want a great home and I'm willing to drive. And then the drive ends up being a point of what's called buyer's remorse. And you end up really frustrated because I own a great home in a great neighborhood that's an hour drive from my work. And with traffic, it takes an hour and a half each way. So now you're looking at 3 hours every day of a commute. That's 3 less hours you spend with your family. That's 3 less hours you spend with your loved ones, being able to go to the Little League game and being able to see all of the events. And maybe that's good enough for you. And for a lot of people, it is. But you can't move the home. So when you think about concessions and you're worried about the commute and you're worried about being there for family, I take that one very, very seriously. You can always make the home bigger. You can always remodel the home and make it newer. You can add on a bedroom. You can add on a bathroom. You can do work to make the home different. You cannot change the location. You can't change the school district. You can't change your commute. Now you can get a job closer, but in general, you can't change the location. So that's one of the biggest compromises, that you have to go in eyes wide open. If I'm relocating with a commute, am I really committed and willing to do this? And do I understand what my trade-offs are going to be? All right, so let's talk about types of property and why it matters. So what do I mean when I say types of property? Well, here's the deal. You've got single family residences, you've got townhouses, you've got condominiums, you've got duplexes, triplexes, and fourplexes. You've got manufactured homes, and then you've got bigger multi-unit properties, 5+ units, which we rarely get into. But just within the things that we just talked about, you have to understand that if we didn't discuss what type of property you're buying, I assumed you're buying a single family residence that is what's called site built or stick built, meaning it's normal construction built by lumber being delivered on site, and they build it on site. It's not a prefabricated home. It's not a manufactured home. It's not a condo or a townhome. It's not a duplex, a triplex, or a fourplex. Why do I care? Because the rules are different for every type of property. So if you get a pre-approval for an FHA loan and you're looking at a single family residence, and then you end up saying, you know what, I'm going to buy a condo. Well, you have 2 problems. First of all, buying a condo has a homeowners association. I never built that into my numbers if we didn't talk about condos. So now your qualification said you qualify for $550,000 at the max as a single family home. And you come back to me saying, hey, John, I got this magic bag of beans. I'm just kidding. Come back to me and say, hey, John, I've got a contract. And I'm in contract for the $550,000 home, and I'm super excited. Let's get going. And then I take a look and I say, well, wait a second, this is a condo. Yeah, I'm super excited. It's got a great pool. It's in a great location. There's a rec center that I can use. My kids love it. It's going to be perfect. Great. But there's a $350 a month homeowners association. Yeah, I'm okay with that. I understand that. Yeah, but I'm not okay with it. I'm not okay with the fact that you have an extra $350 a month I didn't account for. And the most I could qualify you for was $550 with no HOA. Well, no, John, you told me I qualify for $550. Well, technically, you don't qualify for a purchase price. You qualify for a monthly payment. That's the dirty little secret that nobody is really clear about. I try hard to make that clear to my clients. Your pre-approval letter says a purchase price. But the truth is you're not qualified for a purchase price. You're qualified for a monthly payment, because that monthly payment is a percentage of your income, and that's the most we're going to let you spend. And so if you buy a single family residence that's in a gated community, great. But now you have a homeowners association payment that I didn't account for. Maybe you buy a home that's in a high fire danger area that has more fire insurance. Fire insurance is a major issue in California. In Florida, you got major issues with hurricanes, but insurance is becoming a problem. I had a client recently who we were expecting insurance to be $2,000 or $3,000 a year, and he got a quote of $17,000 for insurance. So that's really making the payment way higher than what he qualifies for. You need to be aware of the type of property, both from what that does to your monthly payment, and typically it lowers your buying power, but also different properties have different types of rules. A condo, we have to approve the association as well. So sometimes they have to be on our pre-approved list, not ours, but the industry's pre-approved list. Sometimes we can do an approval just based on that particular condo's financial health at that exact moment. There's different rules about that. Just be aware the type of property matters very, very, very much. All right. Now, how about type of property when it comes to the question of, hey, should I buy a foreclosure or short sale? Does that save me money? Can I buy those using this type of a loan? Well, the answer is yes and maybe. So a short sale, to be clear, is when the owner of the home still owns it, they haven't lost it to the bank, and they owe more than what the house is selling for. So the thing on a short sale is the homeowner doesn't care what it sells for, because they owe $600,000 on the property and it's worth $550,000. They're not getting a penny out of it. They just want to walk away. So if you offered them $500,000, they'd say yes. They'd say yes right away, because they don't care. Offer them $450,000, they'd say yes right away. If you're the only person making an offer, they will accept it, no problem. But it's not their money they're spending. It's the bank's money. And that starts a process at that moment where the bank now has to approve the short sale. And the bank's going to say, wait a second, I see lots of other homes in this neighborhood they're selling for $550,000 to $575,000. You guys listed it at $550,000 and you brought me a contract for $500,000. I don't accept that. You have to have a contract. I won't accept a penny less than $565,000 for this property. Well, now you're in trouble. As the buyer, you wrote the offer for $500,000. You felt like, man, I'm in great shape. And now the bank, who's the ultimate decision maker, says, no, not so fast. Not so fast. I don't accept that because it's my money they're spending. And I believe that if I foreclosed on this property, I could sell it and get $565,000. So I'm not willing to let it go for less than that. Well, now the seller's in a great position, because now the seller can advertise that they have a pre-approved short sale. So if you ever call on a property or look at a property that says it's a pre-approved short sale, it means it went through that process already. And the bank has already said, we aren't willing to accept anything less than $565,000. Well, now they can list the house at $565,000 and say, we have a pre-approved short sale. It shortens the process of the short sale approval because the bank's already looked at it once. But you, as the original buyer that wrote that offer, you have the option to go up to the $565,000. But if you're not willing to, then the seller says, bye-bye. Even though we had a contract that I would sell it to you for 500, it's contingent on the bank approving the short sale, and they didn't. So if you don't want to buy the house, I'll see you later and I'll go sell it to somebody else as a pre-approved short sale. So major pitfalls with short sales, there aren't very many of them. As the market turns at some point in time, we're going to see more. It's called late cycle buyers. So people who buy with small down payment late in the economic cycle where we start heading into a recession. I don't know when a recession is coming, but at some point in time it will. Those buyers who bought late in the cycle recently, right before the recession, and they put a small down payment. Well, they don't have a lot of equity now. If that person loses their job, they don't have the ability to make their mortgage payment. They have to sell. They're likely to be underwater because they have a cost to sell the property. So there are some people who will have to do short sales when a recession comes. The good news is it's not going to happen like 2007 because everybody else who has a job and doesn't lose their job, they have a fixed monthly payment. They don't have to worry about their payment changing. And that's what happened in 07 is nobody had a fixed payment. Everybody's payment changed and it caused a domino effect where house after house after house went short sale and then foreclosure. And that's not likely to happen, but it will happen to some degree. And if you're in that position when you're watching this, just understand those pitfalls of buying a short sale. Buying a foreclosure is a whole different story. Buying a foreclosure, there's two types of foreclosures. I'm going to abbreviate this. I have another video coming out, may already be out by the time that you're watching this, that talks about everything you need to know about buying a foreclosure. But very simply, at the moment a house is foreclosed upon, it is sold at the courthouse steps. You cannot use a mortgage to buy at that time because whoever buys it has to pay cash. But if nobody buys it or nobody bids enough to cover what the bank needs for it, then the bank becomes the owner of the property. Now it becomes an REO or real estate owned, otherwise called bank owned property. That type of foreclosure, they list on the market with a realtor. They sell it for fair market value. So your realtor isn't going to get you a really, really good deal on a foreclosed property once it's been foreclosed. What you're trying to catch is pre-foreclosures. Okay, Anna, this is the moment you have to make the cut. So I'm going to jump back into where I was just saying. What you're trying to catch is a pre-foreclosure. What you're trying to catch is the property before the actual bank auctions it off. That's the moment. It might not be a short sale. It might just be a seller in distress, a seller who has equity, but is about to lose the property in foreclosure, and they're going to lose all of that equity. That's the one spot where you actually can get a deal on a pre-foreclosure. But if a seller has equity and they're not listed for sale right now, there's something emotionally going on where they're not unwilling to face reality. They're unwilling to face the fact that they're about to lose their home. And you and your agent have to convince them of that reality. That's a tough one to do. So just be aware. That's where the deal lies. If you can find that situation where you're buying it from a seller who's been issued a notice of default, been issued a notice of trustee sale in California. Those are the two documents that get issued. And you're going to that seller, your realtor's going to that seller saying, hey, you own this property. You're about to lose it in foreclosure. I've got a buyer willing to buy it from you, and we can create a win-win situation. That's where having a foreclosure, buying a foreclosure helps. But just be aware that the property condition has to be what the lender requires. You can't buy a property that's broken, that has health and safety issues. You have to buy a property that is livable and complete, functional with no health or safety issues. So as you're buying a foreclosed property, be aware of that fact that if the property is in bad shape and it needs repairs, there are programs that we have that can help finance the repairs, but they don't always mix with other programs. So if you're using down payment assistance, we might not be able to have a program that finances the repairs, in which case you can buy a property that's old, that's run down, that's dirty, but you can't buy a house that's broken, that's unsafe, that is not in livable condition. All right, let's go on from here. And let's talk about new construction. So a lot of people say, okay, John, well, you talked about old homes just now and properties that are in bad shape. But what if I want to buy a brand new property? What's the process look like for buying new construction? Well, in this case, you have a whole different set of dynamics. What you have is the person who is sitting at the model home. They are an employee typically of the seller. Now, they are happy to represent you as the buyer. So this goes back to what I said earlier. When you hire a realtor and you have the same person negotiating for both sides, there's a bit of a conflict of interest. You can bring your own realtor if the real estate community, if the new home community and seller allows it. It's called co-op, or bringing in, cooperating with the realtor and them paying your realtor's fee. Now, you can bring a realtor that you're willing to pay for out of your pocket, but for them to pay for it, most of the new home subdivisions who allow it have a rule that says that realtor must accompany you to the property the first time you visit. Their thinking is if you went first, then they're not paying for a realtor to bring you there. You already came. And they don't need a realtor to represent you because they have somebody that they say will represent you. And therefore, they're not going to pay for a realtor. They're really paying the realtor's commission, a commission to the realtor, so that the realtor is willing to show you the new homes while you're out looking at resale homes. Because if they're not willing to pay for anything, a realtor might not bring you to those homes or might not tell you about it because you don't have the money to pay their commission. So therefore, some new home communities will pay your realtor's commission. Some won't, but the ones that will almost always require your realtor is the one that brought you there and accompanied you the first time that you went to visit the property. So be aware of that fact. Can you buy a new construction home without having your own realtor? You sure can, but you're trusting, and all the disclosures are there. The seller's going to disclose everything to you. The agent representing both of you, the sales agent is going to disclose everything to you. But reading through it all and understanding, and especially being able to compare, hey, what if I bought the new house down the street from the other builder instead of from this builder? What are the differences? The person that you're talking to, they don't represent the other builder. They're not going to help you compare. If you have a realtor on your side, they're going to help you compare because they are paid to take care of what's in your best interest. So if you're thinking new construction, go for it, but just understand the timelines involved are also different. Some new construction subdivisions sell homes when they're already almost built. Some sell them really early in the process when it's just bare land. Some have lotteries if there's high demand. Sometimes the price you see is not the price you pay because you have lots of options and upgrades that they end up adding to it. And you very rarely get a backyard. You very rarely get window coverings or things like that, but you get a wonderful home. In today's world, in early 2024, a lot of sellers, a lot of new home developers are giving you great credits, great amount of money towards closing costs. Some of them are giving you incentives with super low interest rates, provided you use their lender. So understand that it comes at a cost because now you don't have a lender that is focused on your needs, focused on explaining everything to you. It's a lender that, first of all, comes on the cheap because the seller has to hire a lender that's willing to do the work for less. Often, not always, often they have less experience and their number one client's not you. The number one client is the seller. And so they're representing the seller. And you get a great deal. I'm not telling you not to do it, but just understand what you're getting yourself into if you do, in fact, use the seller to both represent you from the transaction side on the realtor and on the lending side. You really have nobody who's giving you thoughts and advice on what's in your best interest. So just remember, you get a great deal. Every deal comes with a cost. Is the cost worth it to you? All right, here's a good question. A lot of people ask, John, I see these houses that are out there and my uncle told me that I should never offer over asking price. As a matter of fact, I should offer under asking price. I should offer, he said 20,000 below asking price no matter what. What should I do? Should I offer over asking, under asking, at the asking price? The answer is yes, yes, and yes. Maybe, 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 and no, no, and no. Because it depends on the markets and it depends on the sales process, the thought process with the agent representing the seller and how did they want to approach this market. So I'll give you the three different scenarios you have to think of when you're looking at a property. You have to think about, hey, and have you think about it as a seller. Okay, so if you're a seller and you're selling your home, you would say, you know what? I see houses down the street that have sold for $600,000, but my house is better than those. And so when a realtor comes to me wanting to help me sell my house, and they say, hey, all the houses nearby are selling for around $600,000. I say, yeah, but mine's better. I put in a pool. And they said, well, yeah, but the house down the street has a pool. Yeah, I know, but my pool's newer. And I got a brand new roof. And I put in a brand new air conditioner. And I just redid all of the flowers in the backyard. And my house is better. My house should sell for $625. Well, the problem is that seller is emotional. That seller believes their house is worth more. There are things about their home that are better. But often those things make the house more desirable, not more valuable. As a buyer, you would say, well, you know what, having a newer pool versus an older pool, yeah, maybe I'd pay a little more for it, but not much. Like I have a pool. And so I'm not too worried about whether it's 10 years newer than the other one. I'm not going to, as a matter of fact, I'm not going to spend any more for the house with a brand new pool compared to a 10-year-old pool, or new landscaping in the backyard compared to old landscaping. It's nice to have, but it isn't going to make me pay more for the property. So that's what you need to think of as a buyer is, hey, some sellers think too highly of their home, and the real estate agent either was unable or unwilling to talk them down. Some realtors say, you know what, let's just put it on the market at your number and see what happens. Great. What's going to happen is nobody's going to write an offer. You know that because the property stays on the market a longer period of time. So depending upon your market, this is where having a great realtor helps you, you would find what is called the average days on market, or how long it takes to sell a home. And when you have a home that exceeds that average days on market and there hasn't been a price drop, you have an opportunity to go in and negotiate. That's a seller that thinks their house is worth too much and they aren't getting anywhere. And the realtor is likely beating them down, trying to convince them, hey, you need to lower your price. So they might be saying, okay, fine, maybe I'll lower it to $610 instead of $625. Well, if you came in and said, hey, I'll offer you $625, but I need you to give me $15,000 towards towards my closing costs, the seller would be like, oh my God, that's great. And they will accept it, and you can get a seller credit because they were going to lower the price anyway. You caught them before they lowered the price. The moment they lower the price, you've got a problem because the seller thinks that's what the market is going to bear. And they think, okay, I can sell it for $600, $610 because I lowered the price. Now they might not have lowered enough, but to get them to take a decrease from there, a greater decrease from there, harder to do. Because they think, well, I know I'm starting over with my days on market, and I'm starting over with people looking at my house as a $610,000 home. That isn't always true. Once somebody's looked at a house and checked it off of their list and said, nope, I'm not buying it, they're not likely to look at it again. But just recognize that's the first type of situation where you would typically offer less than market value, less than what the list price is, because they're over-listing the price. We have the complete opposite end, which is a seller and a real estate agent saying, you know what? I think this house will sell for $600, but I have an idea, the realtor says. What if we put it on the market for $550? Imagine how many people would love to have this house for $550. And the seller says, no, I'm not willing to sell my house for $550. And he says, no, you don't have to accept an offer at $550, but we put it on the market for $550. And we get multiple people bidding up on the property. We get all these people who bid the price of the property up, and now they're competing. And once they're competing, they're going to want to go higher and higher. And we're going to get them to pit against each other. I think we can sell it for higher than $600, because once people are emotionally bought into a property and they say, man, I'd love to have this house and I'm willing to have it for $550. Oh, but it's going to take $575. That's still a deal. Oh, it's going to take $600. Well, that's what I was willing to pay anyway. Oh, it's going to take $610. Well, that's only $10,000 more. Oh, it's going to take $615. Well, that's only $5,000 more. You see how that happens? It's death by 1,000 cuts. So there are times when you're going to see a house on the market and you're going to say, oh my God, this house is better than any other house like it at this price. This is a deal. You're likely not going to get the house. There's likely an auction that is likely to happen. Not a purpose. Well, it's not a true auction, but the listing agent listed it low on purpose. If it looks too good to be true, it probably is. So just be aware of that fact. And the final thing I'll say, obviously you have that middle category of the house was priced perfectly, but more importantly, this right after a house goes on the market, the seller thinks they have the right price. So trying to negotiate a lower price immediately is unlikely. It can happen. Your realtor is the expert, but it's unlikely because the seller wants to have more time to have more people look at it. So negotiating a lower price rarely works right after the house goes on the market. Now, there's times when you can do it. And I'll talk to you a little bit about how to make your offer more competitive, and we'll go through some of that stuff. All right. Now, should I ask for seller credits? Well, it's about making your offer competitive. It's about, in the situation I just talked about a moment ago, if the house is overpriced, one of the things you can do is make the seller feel good because you offered them the full price. Now they can tell their friends, see, I told you it was going to sell for $625. Nobody has to know that they offered $20,000 in seller credits because that's not public record. So you can make a seller feel good. And again, other than on short sale, other than on really bank-owned properties and short sales, your seller is an emotional person. If you're buying a house from somebody that lived in that home or owned it for a long time, they're emotional about it. You have to understand emotions come into play as part of negotiations. So just be aware of that fact, because if you can give the seller what they want and get some concessions somewhere else, it's a win. And oftentimes it isn't simply what the seller asks for that they want. And I'll explain that in just a minute. But seller credits are great because they help you to reduce your cash out of pocket. If you're putting 20% down on a purchase price on a home, and you're buying a $600,000 home, so you're putting $120,000 down, and you negotiate a $10,000 decrease in the price of the home, that saves you $2,000 out of pocket. It lowers your loan amount by $8,000. So instead of borrowing $480, you're borrowing $472, but it only saves you $2,000 out of pocket. But if you negotiate a $10,000 seller credit, you keep the price where it was and you negotiate a $10,000 seller credit, that saves you the full $10,000 out of pocket. So it dollar for dollar saves you more money by getting a seller credit than by getting a reduction in sales price. But there's limits to how much you can get in seller credit. So don't go crazy. Talk to me or your lender if you're not using me, which if you're not using me, you are crazy. But don't go crazy in how much money you're getting. There's limits on how much we can get, but sometimes we can use that money for other things, for buying down your interest rate, doing temporary buy downs. I'll have a video in a couple of weeks that goes deeper into that. All right. So let's dive into the meat of this, which is ways to make your offer more competitive. So let's pull up my slide on this. Oh, next one. All right. Ways to make your offer more competitive. So what this is about is how are you going to convince the seller to accept your offer? Because right now in most regions across the country, we are in a very low inventory market. Now, one could argue there's very few sales and therefore it might be a buyer's market, but there's also very few homes for sale, which says it should be a seller's market. And in some cases, it's a neutral market. But you, once you fall in love with a home, want to know, what can I do to help convince this seller to choose me? You need to decide, what do I need to do to help the seller choose me? What things can I do in my negotiation so they pick me because I'm in love with this home and I want to make sure I'm the one that gets it? So the first thing that we have on our list is shorten or eliminate your contingencies. So that is high risk, okay? Your contingencies, you talk to your realtor about this, but you have 3 contingencies. And in July, I believe there'll be a 4th contingency. So the 4th contingency that doesn't exist right now is insurance. Your ability to get insurance on the property, because that's becoming a problem. The other 3 contingencies are appraisal, loan, and inspection. Now, talk to me if you want to eliminate any of those. The inspection contingency is controlled 100% by your realtor, but the appraisal contingency and the loan contingency, there are pros and cons. There's contingency plans for what if your contingency removal causes you a problem. And so I will explain all of that to you, but this is a one-on-one kind of a conversation. But you can shorten your contingency saying, hey, I'm going to make sure the appraisal is done in 7 days instead of 17. I'm going to make sure we have loan approval in 10 days instead of 17. I'm going to make sure my inspections are done in 7 days instead of 17. So you can shorten the timeline. That makes the seller feel better because you're going to be on the hook with your earnest money deposit. I'll explain earnest money deposit in a couple minutes. But if your contingencies are released and you don't buy the home, the seller has the right to keep your earnest money deposit. There's a lot of rules behind it. Talk to your realtor about when they can and when they can't, but your earnest money deposit is at risk. All right, so you can also shorten your timelines for close of escrow. We already talked about contingencies, but you can say, hey, Mr. Seller, I can close this in 15 days instead of 30, and therefore you're going to get your money faster. That's a benefit to the seller in some situations. But in some situations, the seller doesn't want a quick closing. Maybe the seller has to shop for a home and they need more time to find their home or to close escrow on their home. Or the seller needs a rent back, which I'll talk about in a minute. But the other thing you can shorten is the seller's response time. I actually use that tactic in buying the house that I'm buying right now, that I'm in right now, that I bought 3 years ago, that we gave the seller 4 hours to respond to our offer. We did it strategically. It backfires a lot of the time. A lot of the time, the seller says, nope, I am not willing to be strong-armed. You can't give me a short amount of time. Shortening your seller response time is a great way to get an offer accepted. I used it when I purchased my home, but it can backfire a lot of the times. You're basically saying to the seller, you only have a certain amount of time or my offer is off the table. I give the seller only 4 hours to respond to my offer. Now, that worked in this situation because the seller did not want to have to host the open house the next day. And I strategically hoped that was the case, and it was, and they accepted my offer because they wanted a bird in the hand instead of hoping for 2 in the bush. So that can work as well in shortening the response time from the seller. All right, you can decrease the seller's expenses. So the seller is paying fees to the title and escrow, they're paying realtors commissions, they're paying for home warranties. You can negotiate for that stuff to be paid by you as part of your closing costs instead of paid for by the seller. So that can help you to be more competitive because you might not be offering a highest price, but you're offering the highest net amount to the seller. One of the other things we can do is we can have a fully pre-approved, underwritten pre-approval, which helps the seller feel more confident that nothing's going to go wrong with your loan. And it gives you the confidence to release your loan contingency. All right. Have a lender with a great reputation right here, okay? Because the reputation of your lender, my reviews, the number of transactions that I've done gives confidence to the selling agent, the listing agent representing the seller, that working with a professional. They're working with someone that understands their craft and isn't going to come across unexpected problems and not have a way to deal with them. Now, we all come across problems, but the more experience you have, the more likely you run into something similar and you have the ability to work your way through it. Offer a free rent back to the seller. So maybe the seller needs to have time to find a home. And so you can give the seller up to 59 days to stay in the home. Because if it's your owner-occupied property, you have to occupy within 60 days. But you can give the seller 59 days to stay, and you don't have to charge them anything. That makes, you can charge them, like you can charge them what your mortgage payment is, but if you have the means to do so, it makes your offer more competitive. It gives the seller more benefits by accepting your offer. All right. Here's the other thing, and I'll actually start with the second one, offering a larger earnest money deposit. That is actually something that I did on mine as well. The earnest money deposit is the amount of money that you are risking if you back out of the transaction without having a contingency. So on this one, I'm going to actually start at the bottom. I'm going to start with offering a large earnest money deposit. That's the amount of money you're risking if you back out of the transaction without having a contingency that lets you out. Now, the truth is that money is applied towards your down payment and your closing costs. And so if you are already going to spend that money and you have contingencies in place, writing a bigger number doesn't actually add much risk on your behalf, but it makes the seller feel better. And sometimes when everything else is equal, they pick the person that had the highest earnest money amount. The final one is the top one, which is have your realtor call the listing agent and find out what the seller wants. This one's the number one ding, ding, ding winner of all of the scenarios. Why? Because we don't know what the seller wants. You could offer a quick close, but the seller needs a rent back and they need this to be extended as long as possible. You could, by the way, you can combine those together too. You could do a quick close with a rent back, but you don't know what the seller wants. And so if you go into it blindly saying, you know what, I'm going to offer I'm going to offer a fast close. I'm going to get them their money in 14 days. They're going to pick somebody else because that other person gave them something they wanted, like a rent back. You could offer a rent back, but they don't want that because they've already moved out of the house and they're going to pick somebody else. So your realtor needs to call and talk to the listing agent and find out what in the world is important to your seller that we can help make this a win-win situation. That is the single number one best thing you can do. Now, you ready for a bonus? Here's the bonus: escalation clauses. An escalation clause, so let me pull this back up here, how to make your offer more competitive. An escalation clause means you're saying, I'm willing to buy your house for $600,000, but I'll go up to $650,000. I'll pay $5,000 more than anybody else that has written an offer on the home. Just prove to me that somebody else wrote an offer. So if somebody else offered $620,000, I'm automatically at $625,000. Somebody else offers $640,000, I'm automatically at $645,000. You will go over the highest offer by a certain amount up to a cap. Now, those can backfire too, because sometimes the agent will respond, the seller will respond and say, we're countering you at the maximum that you wrote. Well, you can agree to move forward or not. They don't have to just accept your escalation clause because you already showed your hand and you said, I'm willing to go to $650,000. They might counter you and say, great, then I reject your escalation clause and I counter you at $650,000, and that can backfire. So as I mentioned when talking about escalation clauses, the seller uses a form called a counter offer to respond to your offer. So when you and your realtor write an offer to the seller, you're basically saying, Mr. Seller, here's the terms that I'm offering. I'm offering you this purchase price. I'm offering you this I'm going to have this down payment amount. I'm going to pay these fees and you're going to pay those fees. And I'm giving you this much time to respond to me. And the seller has the option to accept your offer, to reject your offer, or to counter offer. So a counter offer is a seller saying, maybe I am willing to move forward, but I don't like some of the terms. I want you to change some of those terms. What are the things that the seller could put on a counter offer? Anything they want. Anything you put into your offer, they can counter. So if you say, hey, your house was listed at $700,000 and I'm offering you $660,000, they can counter and say, nope, I won't take a penny less than $690,000. And then you can counter back to them saying, well, I was offering $660,000 and they wanted $690,000, so I'll offer $670,000. And they'll come back again and say $685,000. And you play the dance. That's called offer, counter offer, and you counter back and forth. So you write an offer, seller counter offer number one comes over and you have the option to accept. Or you can counter back and you can say, nope, I want these terms. And you can volley back and forth. That's part of the negotiation. Sometimes negotiations are done verbally between the buyer's agent and the listing agent, kind of just saying, hey, this is what we're thinking. What's the seller thinking? What's the seller want? This is how we're thinking of putting it together. And that way the offer is clean the way the seller wants it in the beginning. But there still is sometimes counter offers that go back and forth. And sometimes you have no idea what the seller wants. And so you just got to put out an offer. The seller is not obligated to give you a counter offer. So if you write an offer, the seller can reject it, even if you offered full price. Remember earlier I said there are situations where they lowered the price on purpose in order to create an auction effect. You can write a full price offer. They can reject your offer and say, nope, I'm not willing to move forward. There's no obligation for the seller to accept an offer, even if it's at full price. That's a myth many people think is true, but it is not true. So that's how counter offers work. You do not have an actual agreement. You're not in escrow, in contract, until the seller and the buyer have both agreed and finalized. Somebody has accepted somebody else's counter offer. Once the counter offer process is done, then you are officially in contract. Now, there's another thing called a multiple counter offer. People confuse the two. So you think, I've got a counter offer. That means that as long as I accept what the seller said, we're in contract. Let's accept it. Let's move forward. A multiple counteroffer says, I, the seller, have multiple buyers that I'm sending the same counteroffer to. That normally is used in these bidding situations where they underprice the home, or if it's just an appropriately priced home, but there's so much demand, so many people looking to buy the home, that they'll issue a multiple counteroffer. Most of the time what they're saying is, hey, I'm giving you fair warning. There are multiple people looking to buy this home, and you're all being given the chance to strengthen your offer or do what's called highest and best. That means I want you as the seller, I want you, the buyer, to give me your highest offer with your best terms. So give me your best shot and let's see if we can get into contract. And The hard part is you don't know how good you have to be. You don't know how much higher you have to go in your offer when you're in a multiple counteroffer situation. And sometimes they'll counter back again. Most of the time, if you're in a multiple counteroffer, they're just going to accept the one that is the highest and the best and move forward. So that's a bit of the gamble that you'll never know, because when you win, it means you had the highest and the best counteroffer. By the way, highest isn't always best. The highest price is not always the best offer because it has to do with the terms that we spent this entire time talking about. But the multiple counteroffer does not guarantee that if you accept it, that you are in contract. You don't accept a multiple counteroffer. You have to send back what your offer is. It might be the same as the original offer. Just recognize, usually, not always, usually the competition is above the list price. And so if you want your best chance of winning that home, you need to increase your offer over what you originally offered. That is not always true, but usually it's the case. So that's a multiple counteroffer. Now, do I need to do inspections before writing an offer? You don't need to. As a matter of fact, you have an inspection period after you write the offer. I'll talk about that in my next video when I talk about what happens when you go into contract. But you have an inspection period. You don't do inspections beforehand. Technically, you could. Sometimes the seller has already done inspections and there's disclosures that they provide that you and your agent can see ahead of time. Now, seller might do that because they want to make sure that you're not going to nickel and dime them later. So they're going to do the inspection ahead of time and show it to you so that realistically you can't say later, hey, I want a lower price because I didn't know about the age of the air conditioner and that it's probably on its last leg because it was in the disclosures you were provided in the beginning. So some sellers will do that. But if the seller hadn't done it, can you? Well, you sure can. Should you? I'm not telling you shouldn't. What I'm telling you is you have time after you're in contract as long as you have an inspection contingency. And in today's market, houses move fast. You have very little time on market for a well-priced home. And so you don't have the time to schedule an inspector to get out there and look at it before you write the offer. You also truly don't want to spend the money on a house that you don't have under contract. It's expensive and you keep spending more and more money on inspections on homes that you're not under contract. It's going to get really, really expensive really, really quickly. Okay, so you do not need to do inspections ahead of time. You can, but most people don't. It's very rare unless the seller has already done it. One of the next questions that everybody asks me is, John, when do I lock my interest rate? Like we've been through this whole thing. Is my rate locked in? Well, I told you when we pre-approved you, your rate does not get locked in until you get an offer accepted on a home. And even then, we have to have a conversation after that to actually freeze your interest rate. So what ultimately is going to happen is you're out shopping for a home, you're getting your offer, your multiple counter offer, your counter offers, you get it accepted, and now you are in contract. That's when I get a copy of the contract is when we set up an appointment to lock the interest rates. I'll explain all of how that works in a future video, but just right now, understand we don't know where rates are. We know where they're at daily, but we don't know where it's going to be the day you get your offer accepted. And if you get your offer accepted at 7:30 at night on a Friday night, that doesn't mean that day's rate's locked in. You have to talk to me to freeze in the rate, which typically happens Monday through Friday during business hours. Sometimes the cutoff's as early as 2 p.m., depending upon the loan program. The final thing I'll tell you about rate locks is there is such a thing as a lock and shop program. A lot of lenders advertise it. It's not really a great deal. You're going to pay a certain amount of money as an upfront deposit, and the lender's going to freeze your interest rate. And you have between 60 and 90 days to find a home and close escrow at that interest rate. If you don't, you lose the interest rate and the upfront deposit. With the market being tight right now, with very little inventory out there right now, that's a pretty high risk to take. We don't think interest rates are going to go up significantly. You never know. But the fact of the matter is paying money up front for an insurance policy against rates going up, unless you know for sure rates are going up, it's not really a good idea. So can you lock before you find an offer on a home? Yes. Should you? In most cases, no. It doesn't really make sense to do it. All right, let's go. Basically, that's it. So congratulations, your offer has been accepted. What happens next? Well, you're going to see, if you're watching this in the first week after it's released, this will not be true. But about a week from now, I'll be releasing another video that's going to be on what to do once you're in contract. And there'll be a link to that sitting right over here. You can click on that link. If you're watching it before that one's published, you'll see a link to something else really good that you should watch anyway. But make sure that you watch this video. It'll have really good information on what happens next once you're in escrow. If you have any questions about anything, give me a call. And if you're not working with me, you're working with the wrong lender, give me a call. Thanks. Bye-bye.